Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. It's Tuesday, the 6th of December, and we have Jessica Amir, market strategist at Saxo Capital Markets, with us today. Jessica, great to have you on the show.
Hi, Brian. Great to see you.
Now, before I come back to you, Jess, and get your insights, we're going to take a look and see how the numbers look like across the region, and also take a look at crypto markets. We start with Bitcoin, which is just above the 17,000 mark. It's at 17,002.5, down 2.14%. Ethereum is at 1,262.01. It's down 2.95%. Now, looking at across the regional stock markets, in Singapore on the SGX, it's down 0.36%. KLCI in Malaysia is down 0.1%. Shanghai is down 0.14%. The ASX All Ordinaries is down 0.48%. The Nikkei bucks the trend. It's up 0.28%. The Hang Seng is down 1.15%. And rounding up the numbers, we've got the Kospi, which is down 0.76%. Now, Jess, that's pretty much a sea of red with the exception of Nikkei. Tell us why.
Yeah, it's pretty telling what central banks are doing, right? So you've got most of the central banks hiking rates, and the biggest bank of them all, the Federal Reserve, pretty much got a green light to keep hiking interest rates overnight. So anything that's deemed a risk asset is pretty much being sold off. However, of course, we know in Japan, they're the only central bank that are bucking the trend and keeping rates at historical lows. So that pretty much is all we need to know right then and there. So anything with a high PE ratio is essentially being sold off. There are some gains though today. It's not all doom and gloom. If you dive into the indices, you can see some of the best performers are in the fossil fuel space. We're also seeing some small gains in other commodities. But all in all, it's all about money being taken off the table ahead of the Fed's meeting next week.
Now, Jess, I want to zoom in close to home on your end. The Reserve Bank of Australia has just raised rates by 25 basis points. Now, that takes it to the highest level in a decade. What's your take on this, and how is that going to impact not only commodity prices, but also equities?
Yeah, so for equities in Australia, I guess our equity market is pretty much driven by three things, and you pretty much touched on that. So the Reserve Bank, when the Reserve Bank sneezes and hikes rates, that tarnishes our tech sector, which is very much tied to the US consumer. Secondly, when the Reserve Bank of Australia rises interest rates, that also affects our property sector and also our banks. Our banks are under financial duress because we know our loan arrears, and the RBA has alluded to this, loan arrears are picking up, and we see that loan arrears and insolvencies are going to continue to rise, and this is going to put further downward pressure on property prices. So we do see property prices having a very, very sharp correction next year. So that won't be very good for those who are invested in the financial segment. And the last thing that you mentioned was commodities. So commodities are continuing to move to their own beat of their drum. They aren't really experiencing demand destruction down under. So you do have the coal price in Australia that's back in all-time record territory, and this is despite the Federal Reserve, the Reserve Bank of Australia hiking rates and maintaining that they don't really have an indication to slow down their pace of hikes. But yeah, all in all, there is still a lot of risk on the table, but you're continuing to see commodities push higher.
Jess, one of the things that I read into was also the fact that the RBA said that they would continue the pace of rate hikes. Now, isn't that worrying both for the two sectors that you talked about earlier, the property sector, where consumers, as you said, are under duress already, and of course, the banking sector, which is exposed, which has a significant book in Australia, an exposure to the property sector?
Yeah, absolutely. It is a huge concern. For those that don't know watching this, our Aussie share market is made up of predominantly commodities, which are doing well of late on the back of optimism that China will reopen essentially, with some of the largest capital cities easing restrictions of late. So that's why we're seeing iron ore and copper companies make cracking gains. However, if we touch on the banking aspect, yes, it's really worthwhile to point out that Australia's biggest banks and the smaller regional banks have been reporting a decreasing margin. So usually banks make more money when rates rise, but in this phenomenal period, we do have exceptionally high, and the RBA said the word painfully high inflation, and that is a concern when we have Aussie households that are the most highly leveraged households in the world with the highest debt to income ratios. There is a real concern that the property market could collapse, and that the big banks that many people are dependent on for their dividends, I'd say more perhaps old school investors, that the big banks will come under further financial strain and see sharp pullbacks next year in their share prices.
Now, just looking ahead now, we've got the Reserve Bank, the Fed Reserve Bank, basically with their rate decision next week. What else should we be watching out for that could move markets?
Well, I think the biggest concern right now is there is pretty much more headroom for the Federal Reserve to continue to hike rates. We know next week the market has priced in a hike of 0.5%. However, we're really looking for clues that the Federal Reserve can continue with its pace of hikes. Overnight in the US, we saw that the services sector is stronger than expected. The services sector are really important to the US. 70% of their GDP comes from the consumer. So this is basically, a flag saying the Federal Reserve can continue with its pace of hikes, given inflation there is still high, well above the Federal Reserve target. Now, the risk for this, going back to your question, the real risk is that PE stocks, those really high PE stocks, I'm talking tech stocks now, specifically in the NASDAQ, they are looking prime for a potential pullback. So thinking about the NASDAQ, the average price to earning ratio of a stock in there is 40 times. That means you've got to pay for it 40 times before you can even think about getting earnings. And now the market is, I guess, toying with higher for longer rate hikes. Rate hikes are here to stay, but also slowing down of consumption. So we're likely to see a potential recession, and that means that the EPS that the market is looking at, the earnings per share, might not eventuate, and so we could potentially see another very sharp pullback for the NASDAQ. So investors might like to think twice about their positions in tech, maybe potentially take some profits, or look at writing downside protection using options. So there's a lot of risk still on the table. The next catalyst, this Friday's producer prices, but then, of course, looking to next week's decision from the Fed, the final one from the year. So a lot is on the line.
Jess, thank you very much for coming on the show. Thanks a lot for your insights.
Thank you so much, Brian.
We've been speaking to Jessica Amir, market strategist at Saxo Capital Markets, on BizTech's Asian Midday Market Watch, presented by the Smart Investors Singapore. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.